Hi, I'm Mike Desepoli of Desepoli Wealth Management, and this is a quarterly market update. The purpose of this video is to wrap up the first quarter of 2015, as well as give you our views as we move into the second quarter. The first quarter of 2015 looked a lot like the fourth quarter of 2014 as we continue to see a lot of the same headlines dominating the news. I'd like to take each one of these headlines piece by piece here, give you a little information about it, and tell you how it impacts the decisions that we make in regards to your portfolio. The first thing we've continued to see carry over from 2014 is an increase in volatility in the marketplace. Now, volatility is a measurement of the wide swings both up and down in the market as the market reacts to different pieces of news. Now, volatility is not fun, I understand that, but it's also not a bad thing for the market either. We view volatility as an indication to us that investors are not getting complacent about their portfolios, and that's a good sign. Anytime you have complacency, the market is ripe for a fall. So we'll continue to monitor this volatility, but like I said, while it's not fun, we do appreciate the fact that it's present and we think that's a positive indicator for the economy. The second thing that's dominated the headlines this quarter is the rise in the US dollar. And what does that mean for our portfolios? Well, as the US dollar gets stronger against other currencies, it may be a phenomenal thing if you're traveling overseas and spending US currency abroad, as you're getting more bang for your buck, and that's always welcome. But it has a negative impact on large multinational U.S. companies that have businesses here at home but derive profits from overseas, as they're starting to see diminishing returns on their business models. As the U.S. dollar gets stronger, some of the corresponding currencies around the world are getting weaker. And if you're a country that gets paid in Swiss francs and the Swiss franc is decreasing in value against the U.S. dollar, that's hurting your profitability. So that's something we're keeping a very close eye on, being very careful in this, what specific companies we're going to invest in and how this stronger dollar is going to impact them. Another thing we've seen dominate the headlines is the continued fall in oil prices, which seemingly has been occurring for the last 6 months but feels like it's happened forever. Falling oil prices is great for the individual U.S. consumer, as we see a savings both when we get home heating oil or we visit the fuel pumps. The savings may not be huge, but over the long term, and many people in the economy, it's going to have a very large impact financially. Again, there's always a downside to every benefactor in the economy, and the downside is for companies that are in the energy sector, companies that make their money producing, mining, and developing different oil platforms and rigs and distribution chains. So again, we have to be very careful where we're investing, because right now we do not see a good risk-reward relationship investing in energy companies. That's an area that we choose to avoid at this time, and we will continue to evaluate that as we move forward. Another piece of news that we've seen a lot about this quarter is Greece, and whether or not they will exit the Eurozone. As many of you know, Greece has had big financial difficulties over the last couple of years, as they have a very large national debt that just seems insurmountable at this point. They've received several lines of financial aid from other countries in the Eurozone, and they've reached the point where they can no longer seek bailouts. They either need some structural reform that's going to change the path of their country moving forward financially, or the other alternative is they exit the Eurozone altogether. Now, while Greece is not a big player in the global economy, anything that happens around the world tends to have a ripple effect to us here at home. Now, the Eurozone makes up a very large part of the global economy, and while Greece exiting the Eurozone may not have a long-term detrimental impact, it's likely to send shockwaves through the global economy on a short-term basis. So we continue to watch this situation as it develops, as news continues to come out, and to make a decision if that's an area of the world we want to invest in the future. Currently, we choose to avoid that area, as again, I do not see a good risk-reward relationship in investing in those areas. So when we look at the headlines that I just laid out, what does that mean for your portfolio? It means, number one, that we have to change our focus on where we're investing. If a stronger U.S. dollar and falling oil prices is going to hurt large multinational companies that are based in the U.S. and get their profits abroad, that tells us that we need to focus on what we call small cap companies, companies that are domestically focused and derive all their profits here at home. The reason we do that is because a stronger U.S. dollar does not negatively impact these companies. They continue to run their businesses as they do on a day-to-day basis with no care in the world as to where the currency markets are going. So that's why we see a strong focus there. Additionally, we want to avoid energy companies or any indexes that are energy specific or have a lot or a high concentration of oil companies, oil stocks, energy providers. Which is why you'll see for the first time in several years we have removed the S&P 500 from our portfolios. That's not because we're bearish on the U.S. market. We still have a very strong outlook for the U.S. market moving forward. But we think we can seek outperformance by investing in areas that are not weighed down by energy and that are not weighed down by the strong U.S. dollar impacting profitability. In the first quarter of 2015, we focused our portfolio in this small cap arena, and we saw returns of about 3% for the first quarter. Doesn't sound like much, but when you compare it to the Dow Jones, which was slightly negative for the quarter, and the S&P 500, which yielded a return of 0.4% for the first quarter, we saw a significant outperformance. We do think this trend will continue as we move forward, so we have the portfolio positioned to take advantage of this. Another area that we see an opportunity right now is what we call developed international emerging markets. That was an area of the world that was hit very hard in 2012, 2013, and most of 2014. And we see that it ripe as an opportunity to invest right now, as a lot of these countries are on a good footing, they're in a good upward trajectory. We see a lot of profitability in some of their domestic models. We're taking a position in the portfolio for that reason, but a very small one at that. We're kind of just sticking our toes in the water internationally right now, and we'll continue to assess. If that area of the world continues to blossom and flourish as we anticipate, we will increase our exposure in that area. So in wrap up, the way the portfolio is constructed right now reflects a lot of the headlines that you're seeing in the news. We want to avoid companies that make their money in the energy sector as oil prices continue to fall. We would like to avoid companies that are negatively impacted by a rising dollar. We want to continue to build low volatility portfolios so that we can try to mitigate some of these wide swings in the market. And we need to keep a very close eye on Greece and their impact on the Eurozone. That's a brief synopsis of how the portfolio looks right now and some of the things that we're looking at going forward. But as always, we'd love to discuss this with you in person. If you have any questions about the contents contained in this video, or just would like to follow up with a phone call and email, we'd be more than happy to talk you through some of the finer points of the decisions that we're making. Hope to talk with you soon, and thanks for watching.